Hope to conclude this completely by 30 minutes from now, and I will try and conclude my presentation in about 20 minutes to leave time for some questions if you have any. The Dodd-Frank Act, as everybody knows, was signed into law in July 2010. It was a monumental legislative effort and was inspired, of course, by the incredible difficulties and crisis environment that we all went through, and people remember vividly to this day. The short name, of course, is the Wall Street Reform and Consumer Protection Act. Wall Street has been the target of lots of political zeal as well as enhanced regulatory scrutiny. And of course the Consumer Protection Act we're still fighting over in the United States right now without any firm director of the new office, although I hope they will resolve that soon. The objectives that Dodd-Frank was targeting are to promote financial stability of the United States and do that by improving accountability and making the derivatives business in particular more transparent. So we have a better idea of who has what positions, who owes who how much, and where is the collateral to support that. The second goal, of course, is to get rid of the idea that a bank could be too big to fail and thereby end the practice of bailing out firms that get in trouble and try and address the moral hazard that represents. And of course we have the further goal to protect consumers from abusive financial services practices, and in this case Dodd-Frank is targeting the consumers of financial services alone, although we have lots of other government agencies in all countries trying to protect consumers from other industries. The emphasis in Dodd-Frank is financial stability. That's the first title. There are 16 titles, as you can see, and 848 pages of legal regulatory exhortations. The focus that I'm going to take today is primarily inside Title I, because that is where we have the most spelling out of what the implications are for non-U.S. banks. Of course, other relevant sections would be Title VI, where Section 619 is the Volcker rules prohibiting proprietary trading and ownership of hedge funds and private equity funds. And Title VII, of course, lays out all the new regulations for the trading of derivatives, including the use of clearinghouses and collateral, etc. But our focus today is going to primarily be within Title I. If there's interest, we could pursue the others as well in subsequent sessions. The relevant titles, therefore, I show you there. Dodd-Frank focuses on financial stability, right? It doesn't define what financial stability means, really. It certainly doesn't espouse any underlying theory or even refer to any underlying economic or finance theories that might describe what we mean by financial stability. It gives new authorities to as many as 5 different U.S. regulatory agencies to protect financial stability, but of course it says absolutely, or not absolutely, nearly nothing about how they should exactly pursue that goal. I recommend you to read the excellent lecture that Daniel Tarullo gave last October called Financial Stability Regulation, and Mr. Tarullo in there outlines 4 uses of financial stability inside Dodd-Frank, which I found fascinating. Number 1, it's a goal for the new regulatory authorities, which it grants to the various agencies, but it's not a standard that they are to use in trying to bring about financial stability. It's the goal. Second, it gives a lot of power to a overarching agency, which we'll explain more on the next page, the Council, and yet it doesn't say exactly how they are to do that, but it does require that they report to Congress on how we are doing in terms of financial stability. It does provide a direct legal standard in giving the Federal Reserve especially the power to declare a non-bank, and think about AIG or Lehman, which was not a bank but an investment bank, as systemically important in order to bring it under the regulatory umbrella. And there's a fourth use, which is that it's a factor for consideration in decisions when banks apply to the regulatory authorities, especially for mergers. And Mr. Tarullo goes through some of the interesting historical implications in terms of the mergers that took place in 2006, 2007, 2008, and wonders if those would have been approved, because did they contribute to financial stability or not? The goal, obviously, though, is financial stability. So that is something to keep in mind. The Title I has three different subtitles. One establishes the Financial Stability Oversight Council. The second one, the Office of Financial Research. And the third one, additional authorities for certain non-bank financial companies and bank holding companies. This is our target for today. Section 165 addresses the enhanced supervision and prudential standards for non-bank financial companies and bank holding companies. And Section 166 is early remediation requirements. When can the regulators step in order to rescue a dying firm, basically. The Financial Stability Oversight Council is the overarching new regulatory body made up of the members that you see on the slide there. Their primary role will be to report on how we are doing in terms of financial stability, as well as to approve all of the decisions that the various agencies make in determining how to implement and execute the new law. The Section 165 was first addressed in December 2011 when the Fed published guidelines for U.S. bank holding companies, and then again in December 2012 when they published the guidelines for comment on foreign banking organizations, or FBOs. Those two documents are available at the footnote that you see there. And our focus for today is going to be primarily on the FBO that came out in guidelines that came out in December. So first thing to keep in mind is that the U.S. has long had a welcoming stance vis-a-vis foreign banks, but the new approach wants to incorporate important lessons which came out in during the days of crisis. The International Banking Act in 1978 was the first time that the Fed was given regulatory authority over U.S. operations of foreign banks, and it also equalized the regulatory treatment of foreign and domestic banks, which is a theme you will hear over and over and over out of the U.S., that foreign banks are competing on a level playing field with U.S. banks. In 2001, the Fed said that they have total faith in the regulatory capabilities of the home countries of the foreign banks, and therefore if it is a U.S. bank holding company that's owned and controlled by a foreign bank that is well managed and well capitalized, then they will not impose any U.S. capital requirements as they normally would with bank holding companies. That idea is changed, at least as far as the proposals that came out in December recently. The Fed is very interested to remind us all that the role of foreign banks vis-a-vis their non-U.S. affiliates or parent banks in other countries changed drastically during the last 15 years. Used to be that they were receiving funding from their parents, and of course by the mid-2000s it had switched to the other way, and basically they were using the U.S. as a source of funding for non-U.S. affiliates. And during the crisis, the U.S. led the way with Lehman Brothers in terms of capturing liquidity and keeping it in the home country rather than using it to take care of problems in host foreign countries. And the experience that the Fed had was that that is likely to be the case whenever we most need to have the liquidity. So that idea, together with the need for keeping capital and liquidity in these, form the thrust of the new regulations that have been proposed in December. So here I'm quoting from the proposal itself to explain the lessons from the crisis. The thrust of this is that the location of capital and liquidity made it difficult to count on that from a global point of view. Basically, it stayed where it was, trapped at the home entity, which was the case with Icelandic banks and, of course, Lehman, as I mentioned. And while the foreign bank capital regulatory regime in the U.S. was working very well and allowing banks to have a much more efficient management of their capital and liquidity in good times, it also proved a problem in bad times because the non-host home country locations were not able to tap into any liquidity, and often there was no capital to protect the local operations. Nationally based regulatory regimes made it more complicated to resolve big, huge cross-border financial firms in trouble. And the other thing to remember is that foreign banks have a huge share of the banking business in the U.S. 10 foreign banks account for more than 2/3 of foreign bank third-party assets, so we have big concentration. And there are 23 foreign banks who have at least $50 billion of assets in the U.S., and of course that's the threshold that Dodd-Frank laid down for special prudential measures for domestic firms. So 23 foreign banks above that size and 25 U.S. banks above that size. All of this is preamble to why the Fed is stepping up the regulatory stakes, basically. The focus of the proposals in December 2011 is the same in December 2012. The focuses are, of course, on risk-based capital and leverage, on liquidity, on risk management process and demonstration of heightened risk management standards, on how banks run their risk committees and what kind of supervision they have to provide and testify to. Stress testing, of course, has now two flavors. One will be mandated annually by the Fed, and the Fed expects as well that companies will run their own, so they will have at least 2 stress tests to comply with each year. They have limited the maximum exposure to any given single counterparty as well, and of course put in the early remediation regime to make sure that they can step in early and take increasingly stringent corrective measures as they see the need. These are the same focuses that they have now proposed guidelines for FBOs, foreign banking operations, in December. So it's broadly similar to the U.S. bank holding company proposal of a year earlier. It's focused on foreign banks with total global assets above 50 billion U.S. and with a banking presence in the United States. That could include branches, agencies, rep offices that could include commercial banks, that could include securities businesses, swap trading, futures trading, etc. Any company of which the foreign bank is a subsidiary will be, the foreign bank that owns presence in the U.S. will also come under this regulation. And the foreign banks are going to be required to form a holding company in the U.S. to hold all of their subsidiary companies inside the U.S. This is a new requirement. It is a proposal, it should be noted, and the Fed is seeking comment from foreign banks on what the implications are of this. Overall, they have asked 103 specific questions and want answers back from the industry. Although the deadline is 31st of March, there are none yet. There are 3 on the website at the Fed at the moment. And the intermediate holding company is the newest and most interesting piece, because of course that intermediate holding company will be subject to all of the same capital and liquidity and other requirements that all bank holding companies are in the United States. So you can see a table that spells out what the requirements are. If you have less than 10 billion in total global assets, then you are not picked up by the new proposals. Between 10 and 50 billion, you want to do business in the U.S., you want to have a U.S. risk committee, and you've got to meet your home country stress test requirements as long as they're broadly consistent with U.S. requirements. So that's less than 50 billion in global assets. Above 50 billion in global assets and above 10 billion in U.S. assets, we get a ramp up in terms of the regulatory scrutiny. The home country capital standards, as long as they're broadly consistent with Basel standards, are the test below 10 billion. And if you have U.S. assets that exceed 10 billion, then you must form a intermediate holding company to hold your subsidiary business, banking businesses in the United States, and that will be subject to U.S. bank holding company capital requirements. Now, notice that does not pick up the branches, rep offices, or agencies. This is only for banking businesses that are incorporated in the U.S. and owned by the foreign banking organization. The stakes are raised even higher if the assets in the U.S. are also above 50 billion. So we have the capital plan rules and all of the Dodd-Frank Act stress test requirements under CCAR. We have the monthly liquidity stress tests and in-country liquidity requirements for the holding company as well as the branch and agency network. There must be a U.S. risk committee and a chief U.S. risk officer, and also subject to the Dodd-Frank Act early remediation requirements. So the focus here is on ensuring a regulatory regime, ensuring adequate capital held in the United States, and ensuring adequate liquidity in the United States for all operations of foreign banks. And it remains to be seen whether this will be enacted, but of course that is exactly what has been proposed. I made a picture here that tries to show the differentiation of a foreign banking organization. Of course, it is regulated in its home country and has its businesses in that country and other countries. Then we move to the U.S. Branches, rep offices do not need to be picked up because they are not U.S. companies, but they will be there, and they are regulated by the home country and also subject to U.S. regulations. However, U.S.-owned businesses, banks, broker-dealers, swap dealers, futures commission merchant, commodity trading advisor, etc., those have to come into the intermediate holding company, which, as I said, is proposed to be subject to capital and liquidity requirements. So that is a very brief overview of the proposals for foreign banking organization regulation in the United States. And if you have any questions, I'd be happy to try and answer them if I can. And if I cannot, I'll tell you. Thank you.
That's great. Thank you very much for that, Patrick. We now turn to some questions which have been submitted. So we have a number of them come through, but we only have a limited amount of time, so we'll go straight in there. The first question that we have is, could there be any future limitations on bank size and other requirements for large financial institutions?
Not as proposed so far. The limitations are going to come in from the Basel side in terms of the globally systemically important banks, GSIBs, and there's definitely a penalty for becoming too much of a systemically important bank, and that will be incorporated into the U.S. regulatory framework as well.
Thank you, Patrick. We have another question which says, could the Dodd-Frank Act affect a bank's expansion plans?
Well, it definitely will impact any bank that is hoping to expand into the United States, because the implication is once you get above $10 billion in U.S. assets outside of your branch, you have to hold capital and liquidity in the United States and be subject to the complete regulatory scrutiny that Dodd-Frank prescribes, along with Basel II, Basel 2.5, and Basel III.
Thanks, Patrick. And another one which came through is, does the Dodd-Frank Act aim to reduce market and regulatory reliance on credit agencies?
Yes. Dodd-Frank took dead aim at the credit rating agencies and says that it is no longer permissible to use ratings from credit rating agencies in the calculation of risk-weighted assets. That, of course, means that the U.S. had a bit of a dance to do in order to try and comply with Basel II, 2.5, let alone Basel III, and the Fed has been working on that ever since the Act was passed. But the goal of Dodd-Frank is to stop all reliance on credit rating agencies.
Thanks, Patrick. And we have another question here. Begins with, these are current proposals. Is there any time frame for when they become law?
It's a good question. They are proposals which were published in December 2012. The comment period ends on 31st of March 2013. And then the Fed will take into considerations all of the comments, engage in lots and lots of discussions and negotiations, and I would guess by the end of 2013 they would hope to say what they think the new regulation is going to look like. It is supposed to be finalized, or they will look at the size of banks on July 1st, 2014 to determine which banks, which FBOs fit into which box on my chart before. And then those FBOs will have until July 1st, 2015 in order to bring themselves into full compliance with the new law, or with the new regulations.
Great, thank you very much, Patrick. I think that actually wraps it up for today. Thank you very much all for joining. We've had a very good response to this. Within the next 48 hours, copies of this PowerPoint and presentation of this recording will be sent to all participants. Just as a summary, as a leading provider of knowledge management services here at Intuition, we do provide numerous types of learning solutions, such as online courses, and tutorials, learning portals, mobile learning and classroom tuition. If you would like to have more information on these, or if you'd like to discuss any current learning strategy requirements you currently are reviewing for 2013 or beyond, please do contact us on info@intuition.com. That is info@intuition.com. Thank you very much once again for joining, and have a good day. Goodbye.